yo le pido ahí al equipo de producción que por favor nos coloque a el siguiente invitado que tenemos aquí en esta tribuna. Su nombre es Kaeppel. Y una de las cosas que estaba revisando cuando estábamos detrás de bastidores hablando con él es que efectivamente a lo mejor nos topamos y nos cruzamos porque él tiene una cantidad de horas de vuelo interesantísimas en el mercado de capitales. Para que ustedes tengan una idea, él había formado parte importante de lo que era una compañía que se llama Alpha Investment Management, pero anteriormente él había trabajado en una de esas compañías que cambiaron la trayectoria en toda la parte de opciones, que se llamaba Optionetics, y indudablemente es un excelente analista técnico. Le vamos a dar paso y le vamos a dar la bienvenida a Kaeppel. Jay, how are you? How you doing? We're here, well, as you see, directly from the New York Stock Exchange in something historic for our TV station, where it's the first TV station financially focused that is actually broadcasting from the New York Stock Exchange. And I would like, first of all, your opinion about what just happened in the market, and then probably we're going to try to see how do you see the S&P 500 compared with the 200 moving average. But I want your opinion about what you saw about the markets and what do you think it might happen in the next few trading days. Thank you for coming, Jay.
Well, thank you for having me on. Well, we got through a Fed announcement without a major event, so we're pretty fortunate in that regards. As far as those kinds of events, though, what I always tell investors is the question is not what's the market going to do. The question is, what are you going to do? It's really important to have a plan as to what you're going to do. And some of the things that I look at, the first chart that I have today is the S&P 500. Chart number one with the 200-day moving average. And, the trend is the most important thing. News events and all the indicators that we follow, in the end, price is the most important. And so what we're seeing here is the S&P 500 right now is below its 200-day moving average. There's nothing magic about 200 days, and sometimes it will drop below there and just turn right back around. And if you sell when it goes down, you get whipsawed and you have to buy back in. But when you get a major bear market, by playing some defense, i.e. maybe raising some cash when this is under the 200-day average, you can save yourself a lot of grief and aggravation and a lot of money. So given this current configuration, I am not personally fully invested. If it gets back above there, I'll be more aggressive, but as long as it stays below there, it's time to play a little bit of defense, in my opinion.
Hitting the people in the floor, all the market makers talking about, and you've seen them yelling because we turned green. Now the Dow Jones is around 105, 1% up. The Nasdaq is around 1%, which is 0.74% up. And obviously the S&P 500 is also up. And seeing some sort of momentum, and I'm listening here on the floor, more and more orders, more and more bells ringing. So basically, even though we are at that level, which is a little bit complicated, I'm seeing people hitting the floor, making orders, making markets, and potentially buying. And you and I know that there is a lot of cash on the side. So what do you think it might happen if we regain that level in the S&P 500? And I don't know if you want to talk that in your next chart, but it's extremely interesting how is the sensation in the floor, and I want you to mix that into your explanation about the markets as of now, Jay, please.
Sure. So, as I said, right now, on an objective basis, I can say the market is in a downtrend simply because it's below that 200-day moving average. And again, it doesn't mean it's going to stay there. But it's hard to predict when and if. My guess is it's going to struggle to get above there. Typically, I'm hoping we don't go all the way back down to the old low, but that is one of the possibilities. So as long as it's under here, again, still playing some defense. On the brighter side, chart number 2 that I have, as you might guess, at Sentimentrader, we look at a lot of sentiment indicators. And there's one that we developed, we call the pánico-euforia model. And basically what that chart, when that comes up, it will show it's got the S&P 500 on top again. And then on the bottom, what we will see is sentiment. And it's very simple. Human nature never changes. That's the great thing about analyzing sentiment. At the extremes, it's almost always wrong. So the second chart, anytime that panic euphoria model gets down to a low level, it tends to set up a buying opportunity. And that's where we are right now. And so I don't know if that chart's going to come up, but if it does, it will be a lot more clear that we're down at a very low level. In other words, people definitely panicked in the last, here we are. So this goes back about 30 years, and in those green rectangles that you see at the top, the S&P goes down and the indicator at the bottom plunges, meaning people are panicking, people are scared, people are dumping stocks. And then if you go to the far right, you are here, you are down at a low level. So what this tells me is to look for the market to be higher 6 to 12 months from now. Now that's not 6 to 12 days or 6 to 12 weeks. That's harder to predict. But again, I'm looking at this to tell me that it's time to be ready. So even though I have some cash sitting on the sideline, I'm ready to commit it if the stock market will confirm an uptrend. In other words, I don't try to pick the bottom.
Jay, one of the things that captured my attention is when you are, and I'm going to go to chart 3 now, the credit spreads. Because as you know, there is an old adage in Wall Street where the bond traders are the smart guys, and I don't want to say that too loud here because they're going to kill me. But in any case, I want to put that to you because obviously you're going to talk about the credit spread, and I think are pretty important and interesting what we're seeing now, specifically on that regards, where you know what's going on with the 30 years, with the 10 years, and also the 2 years would seem to be telling us Fed might have to lower rate at some points this year. So what do you think about that? And it's very important and interesting, Jerry, if you can give us an explanation out of that situation, please.
Yeah. So again, this is the second chart, the panic euphoria, saying we're set up. We've had the panic. Now we're just waiting for a catalyst to get the market going. And what I think it could be, and what I'm looking for is this third chart, as you mentioned, credit spreads. When there's a panic in the market, people dump high yield bonds, which drives their yields way up relative to higher rated securities. So you can see where these red lines are. The S&P goes down and the credit markets panic, and you see the spike in that blue number. That is something called the CDX index, which actually measures credit default swaps, which I won't bother going into, but you can see the relationship. The market goes down and this indicator spikes. What I'm looking for, what I look for with this indicator, you see the blue line where it spikes, but you also see the green line, which is the 100-day moving average of this indicator. And what I look for is a spike to tell me that there's been a sell-off, that there's fear in the market, and then I look for that blue line to drop back below the green line to say, not necessarily all clear, but that the fear has abated and that the market has turned the corner. So if you look at the far right in that red box, you see where we are. We had the fear, we had that spike up when the tariff wars began, and now it's starting to come down, but it's still above that green line. So again, that's part of the reason I'm still playing some defense. But if and when this indicator drops back below the 100-day moving average, to me, that will be a sign to get more fully invested in stocks. Yep.
Is kind of, even though the markets didn't reflect any rally, I'm feeling some sort of a good, let's say, and positive sentiment. But one of the things that captured my attention, and you're going to discuss it in the next chart, is potentially the ADRs, and next to me are guys making markets in Argentina, Brazil, and other part of the regions in the world, like Europe and Far Asia, Far East. And I know you were about it. You would like to talk about the potential and obviously interesting part with regards of the non-US markets. And you see kind of a sentiment that you might have to position because there is some people saying that the exceptionalism of the market is about when in terms of the US, and that you have to start allocating outside. What's your opinion? Because in the other corner, I'm still seeing these guys bullish on the US, so there is a lot of confusion. You understand that pretty well. So tell us, what do you think about that, Jay? Because we are around 9 minutes from the close of the historic day today, May the 7th. What do you think about the non-US market, Jay?
Well, I think it's definitely time to be paying attention. So the chart that's on the screen right now, the main line is the performance of non-U.S. stocks relative to the S&P 500, or actually the S&P 500 index. And as you can, this is a 5-year chart, and you can see it's been mostly down. And in fact, if we extended it back, this goes from about 2009. I mean, U.S. stocks have been outperforming for a very long time. And the history of this relationship is it goes back and forth, typically in 3 to 7 year waves. So the fact that we're about 15 or 16 years into outperformance for the U.S., it's not going to last forever. But the tricky part is, you know, you can see the 2 red boxes where it kind of looked like it does now. It looked like it was turning around. And a lot of people said, well, it looks like it's time to get into non-U.S. stocks back in I think it was 2021 and about 2023. And it didn't follow through. And now here at the far right, here we are again. And, you know, I like the phrase, there's always a bull market somewhere, right? And our job as investors is to find that. And right now I'm keeping a close eye, because the other piece of good news regarding non-U.S. stocks is a lot of indexes, a couple of ETFs that trade here in the U.S., broad-based international ETFs, ticker EFA, ticker EUFN. These have been breaking out the new highs, and a number of the single country ETFs have been also breaking out to new highs. I would be much more concerned about the overall health of the market if those were also breaking down the way the S&P 500 did. So I think it's a good sign that the rest of the world seems to be weathering the storm okay. And if this chart that you see, what I'm looking at, the blue line is basically a 50-week moving average. And really the missing piece of the puzzle is for that to turn higher, meaning the momentum has turned in favor of international stocks. And at that point, I would definitely increase my exposure globally.
Mira, listen, Jay, give me 1 second so I can tell them what you just mentioned en español. Una de las cosas más importantes que nos está diciendo Jay, que también hemos escuchado aquí en el piso, es efectivamente la necesidad de seguir haciendo mercado. Aquí están lo que se llaman los hacedores de mercado, y efectivamente ellos están tratando de entender cómo hacen algún tipo de arbitraje, que son aprovechar oportunidades que tienen que ver con los mercados internacionales. Jay, we have around 30 to 40 seconds. And obviously, I want your opinion in something extremely difficult to forecast, which is, where do you see the S&P closing at the end of the year? They lower the expectation to a kind of this bracket. But what is your opinion? You are a seasoned guy. You know, you have a lot of experience. You've been seeing bear markets as well as bull markets. Where do you think we might have an opportunity to close, if you have to guess, because it's extremely difficult?
Sure.
And then if you can summarize that in 30 seconds, that would be great. Thank you.
Sure. Well, first off, I'm not very good with predictions. You know, our job is to just try to be as objective as possible in weighing the evidence. And what I've seen in the last 3 weeks is exactly what I saw in late 2022. I mentioned I follow a lot of indicators, and I don't use those necessarily as buy signals, but as weight of the evidence. And in late 2022, they just started giving signal after signal, bullish signals. And that's what I've been seeing in the last 3 weeks. A lot of indicators starting to fall on the bullish side of the weight of the evidence ledger. So if I had to guess, I expect the stock market to be higher 6 to 12 months from now. But in terms of my own investing, once again, I'm not fully invested. I'm waiting for the market to offer some confirmation, both in terms of price action, as we saw in the first chart, and then the credit spread starting to ease, as we saw in that third chart.
Listen, Jay, thank you very much. We're about to close like a 4 minutes and change to the close of May 7th. Thank you very much.
Right.
You and I will be talking more and more now that we both are in the U.S. It is a pleasure speaking with you and reconnecting with you. Thank you very much, Jay.
Good talking to you. Thank you again for having me on.